Hello. Consumers faced with higher prices. Welcome to today's mortgage market update for March 10th, 2022. We have a lot to cover today, so hold on tight and stay tuned because there's a lot to cover based on everything going on around the world that's affecting our markets and affecting the mortgage industry. So first, the talks between Russia and Ukraine that happened yesterday, unfortunately, they did not amount to anything. There was no ceasefire, there was no safe passages for civilians, and because of how this ended in a negative way, the stock market is down today, the bond market is down today, and it's unfortunately just not good for any of our markets. Now, let's talk inflation. And because of everything we just talked about, this is coming on off the heels of a red hot CPI, a consumer price index report that came out this morning. Oh, inflation. We've been talking about this for a year, right? And last month we told you that we were expecting to hit the peak inflation this month, right? We were going to level off. We were going to start seeing it kind of just rise and cap out. But that was all before gas prices continued to go up. It was before Russia invaded Ukraine. And all that affects our markets. So the CPI came out this morning and it was for the month of February. So it doesn't include anything that's happened in the month of March. This was just for the month of February. And our inflation went up 0.8%. And this is for a year over year increase of going from 7.5% to 7.9%. This is the highest increase we've had since January of 1982, the highest in 40 years. And in January of 1982, it was 8.4%. And I hate to tell you, but I think we could get there as early as next month. So hang on, we're in for a ride, but we're all in this together. So when you strip out the core reading, now remember this takes out food and energy, it also rose by 0.5%. And we went from 6.4 or from 6.4, I'm sorry, from 6% to 6.4%. And I do want to show you this because it's good for you to see this. So this is from the Bureau of Labor and Industry, and you can see this is the actual inflation reports coming out. So when you look at year over year readings, next month we're going to drop off this February and March, and we're going to pick up the new March. So you can see we're dropping off these lower numbers and picking up higher numbers. And if you want to see a 12-month chart here, you can see the inflation going up. So the blue line is the total inflation, and the red line here is the inflation when you strip out food and energy. Okay, let's go back. Now, I do want to look deeper into the report and pull out some things that you should know about. The biggest increases for inflation that were in the report came in gasoline, shelter, and food. Now, gasoline rose by 6.6% in February, and this is before all the major gas hikes we had because of the war. So this is all stuff prior to the invasion of Ukraine. And then the food increases that we had, the cost of eating out went up 1% in the month of February, and the cost of buying food for eating at home went up 1.4%. Now, those two food indexes, that was the largest increases we've had since April of 2020. Now, the Fed is meeting next week to talk about raising the Fed rate. So if you've been watching my reports, remember raising the Fed funds is going to help inflation, or normally it will. So the rumor was they wanted to raise it by July 1%, 100 basis points, and that would help curb inflation. Next week, we're expecting them to raise it 0.25%, so 25 basis points, and that's supposed to help curb inflation. Now, that's all before you figure in the rise in oil prices, which is not figured into this report. So when you take in the rise in oil prices we've had in March, pulling out of Russia's oil, that is not figured into this report. So you need to make sure you understand that and expect CPI to go higher next month. Now, things that are also going higher, and these are good things here, the national home prices increased to a new high according to the CoreLogic's Home Price Index report. We actually gained 19.1% year over year in appreciation in our home. So that's the largest increase in appreciation we've had in our home since they started keeping record in 1976. So home values are still going up. So that's really great news. And because home values are going up, CoreLogic's fourth quarter homeowner equity report also came out this morning. And this showed that equity in people's homes, because remember, you have appreciation giving you equity, and then people are also paying their mortgages, so they're paying down their balances. So they're getting this whole equity in between. That rose by 30% in the past year. So that's incredible. So on average, $55,000 in equity the average person has in their home now, which is amazing. Because if you think back to 2000, 2006, 7, 8, people did not have equity in their homes. So that's awesome. And even with rates moving higher, this is still a really good time for people to refinance, because they can remove mortgage insurance now because of that equity, and also because of debt consolidation. So we can pay off debt that they have. So I want to show you another chart here, which is great. Let's see. So if you look, because we are headed for another recession, and this is a chart showing recessions in the past, along with the housing market and how the housing market handled the recessions. So, you all the way back to the 60s, the darker line here is recessions, and the line going up is the housing market. So you see recession, housing market, and you can see the housing industry always went up with every recession except for the recession we had in 2008. And that's because back then we had so much inventory on the market and not enough demand. We are in the opposite problem right now. We are 6 million households behind nationally. There is not enough housing. People can't even find housing to rent. So even though we are headed into another recession, home values are going to continue going up because there's just not enough housing for us right now. So don't worry about the value of a house. It's still an incredible time to buy. And I just wanted to bring that out to your attention as well. And the last thing I wanted to bring up is Mortgage Bankers Association came up with mortgage apps for last week, and purchases rose by 9%. They are down 7% year over year, and just because of lack of inventory. Refinances also rose by 9% last week. They are down 50% year over year. And that's just because most people that were doing a rate term refinance have already taken advantage of the lower rates. But refinances are still making up 50% of overall mortgage applications. And that's because people are taking advantage of that equity in their home to get rid of mortgage insurance or to do debt consolidation loans. And this is all knowing that interest rates are 7/8% higher than they were at this time last year. And the last thing I want to show you before we jump off is we always like to show you where the mortgage bonds are at. So this is how we know to tell clients if they should lock, if they should float. So you can see from, this is going back to December last year, and how mortgage bonds have gotten worse and worse and worse, meaning rates were getting worse and worse and worse as well. So the rates were going up. And you can see here, February 23rd, this is when the war started in Ukraine. And you can see rates actually got a little bit better. And that was because when there's uncertainty in the market, people take their money out of the stock market and they put it in the bond market because it's a safer investment. So it actually helps our market when there's uncertainty like that. So that's why you saw it get better. This day right here, we had this big red line. That is when Russia actually declared a cyber war on the US. And that's why there was a big drop off in the bond market. So it actually hurt the stock market and the bond market that day. And it's just been very volatile ever since. I mean, there is a lot going on, as you know, in our world right now, that nobody can tell you what to do. As you can see, we are being advised on the locking bias right now because there's just a lot of uncertainty. So we are advising our clients to lock. If rates do drop back down into the twos or the low threes, we can always refinance you, and we'll tell you if it makes sense or not, depending on how long you plan to be in the property. But we just like to give you an update on what's going on. If you have any questions, please don't hesitate to reach out to the Rebecca Foote Mortgage team. I know it was a long update today, but we try to keep you updated with what is going on in the industry. Any questions, our number and website is there on the screen. Have a great rest of your day.